Imagine waking up on a random Tuesday morning, opening up your phone while reaching for your morning coffee, and seeing a notification that a multi-billion-dollar company just deposited $42.15 directly into your account. You did not have to clock in for a shift. You did not have to answer emails from a boss. You did not have to trade a single minute of your time for that cash. It showed up because you own a tiny piece of that company, and they're sharing their real profits with you. That is dividend investing in a nutshell. It is one of the cleanest, most satisfying ways to build real passive income in modern history. But if you listen to internet gurus, you might think you need $500,000 sitting around just to make $20 a month, or that you need to be a Wall Street stock wizard who stares at green and red charts 12 hours a day. The reality is way simpler, way more relatable, and much easier to start than almost anyone tells you. Today, we are opening up the whole hood on dividend investing. We're going to look at why this matters right now, how it actually works using a simple real-world analogy, step-by-step instructions for getting started, 5 real-world math examples with exact numbers, the sneaky mistakes that destroy beginner portfolios, and answers to the top questions everyone asks when they start out. By the time we finish, you will know exactly how to set up your own dividend income machine that keeps paying you year after year. Let's dive right in. Why does dividend investing matter right now, especially for those of us navigating life in our 20s, 30s, and 40s? Well, look around. Everything is getting more expensive. Rent, groceries, eating out, gas, insurance, you name it. Standard raises at work rarely keep up with the actual cost of living. If your income only comes from trading your time for a paycheck, you are stuck on a hamster wheel. The moment you stop running, the money stops flowing. High-yield savings accounts are great for emergency cash, but they do not grow your underlying wealth over decades. Real estate requires huge upfront down payments, tenant management, and fixing leaky toilets at 2 in the morning. Dividend investing sits right in that sweet spot. It gives you ownership of world-class businesses that pay you cash payouts just for holding their stock, while the value of those businesses can also grow over time. It gives you a second stream of cash flow that is completely decoupled from your labor. To really get how this works, let's use a simple analogy. Imagine you want to buy an apple orchard. You buy a single apple tree for $100. Throughout the year, that tree grows bigger, which makes the tree itself worth more money. But every single autumn, that tree also produces a basket of fresh apples that you can sell for $5. That basket of cash is your dividend. Now, you have 2 choices with that $5. You can take the $5 and spend it on a sandwich, or you can take that $5 and use it to plant a small new sapling right next to your first tree. Next year, you have your main tree plus a new sapling. Both produce apples. Now you get $6 in baskets. You buy another sapling. Fast forward 10 or 15 years, and that single tree you bought has turned into a massive, lush orchard producing crates of apples every single season without you ever buying another tree out of your own pocket. In the financial world, those apple trees are shares of stable, profitable companies, and the apples are dividends. A dividend is simply a cash reward that a company pays out to its shareholders from its excess profits. When big companies like Coke, Procter & Gamble, or Home Depot make billions of dollars in profit, they do 2 main things with that cash. They reinvest part of it to expand their business, and they return the rest to the owners of the company, which includes you if you own their stock. Payout frequency usually happens every 3 months, for times a year, though. Some special investments pay out every single month. When people start learning about dividends, they hear a few technical terms that sound intimidating. Let us decode them right now, so you sound like an expert. The first term is dividend yield. All dividend yield means is the annual payout percentage relative to the current stock price. If a stock costs $100 per share and pays you $4 in total dividends over the course of a year, the dividend yield is 4%. For divided by 100, if the stock price goes down to $50 and the dividend stays $4, the yield becomes 8%. Yield is just a quick snapshot of how much cash income you get back per dollar invested each year. The second term is payout ratio. This is the percentage of total profits a company uses to pay its dividend. If a company earns $10 per share in profit and gives $4 to shareholders, the payout ratio is 40%. That is super healthy because it means the company still keeps $6 to pay debts, build new products, and deal with unexpected emergencies. If the payout ratio is 90% or higher, that means the company is giving away almost every dime it makes, leaving zero room for error if business slows down. The third term is DRIP, which stands for Dividend Reinvestment Plan. DRIP is an automated feature in almost every major broker account that takes your cash dividend the exact second it gets paid and automatically buys more fractional shares of that same company or fund. That is how you turn on the automatic snowball effect without having to manually execute trades every few months. Now, how does dividend investing actually work step by step in the real world? It is a four-stage process. First, you pick a solid investment account, such as a traditional brokerage account or a Roth IRA. Second, you choose high-quality dividend-paying assets, either individual dividend-growing companies or, even better for beginners, a dividend-focused exchange-traded fund, which is a collection of hundreds of dividend stocks bundled into a single share. Third, you enable automatic dividend reinvestment, so your payouts automatically buy more shares. Fourth, you consistently contribute new money every month, allowing time and compounding to do the heavy lifting. To see how this transforms your financial life, let us walk through 5 concrete math examples with real numbers, timelines, and percentages. Example number 1, starting with a tiny balance. Say you invest $100 a month into a well-known dividend ETF that has a 3.5% yield and an average dividend growth rate of 7% per year. In year 1, you deposit $1,200. At a 3.5% yield, you will receive $42 in dividends over the course of that first year. That does not sound life-changing on day 1. It buys you a couple of coffees or a fast food meal. But look at what happens in year 5. With consistent $100 monthly deposits and reinvested dividends, your total balance grows to roughly $7,200, and your annual dividend payout jumps to nearly $290 per year. Now your dividend pays for a full tank of gas every single month without you working extra hours. Example number 2, reaching the $1,000 annual income milestone. Let's scale up the effort. Suppose you put away $300 every single month into a dividend strategy yielding 3.5%. Assuming a reasonable total annual stock return of 8% combined with dividend growth, after about 7 years, your portfolio balance reaches roughly $34,000. At a 3.5% payout, $34,000 generates over $1,190 in cash dividends every year. That is $100 in passive cash flow dropping into your account every single month. That pays your internet bill or your streaming subscriptions completely. On autopilot. Example number 3, the full 20-year snowball effect. Now let us look at what happens when you let time do the heavy lifting over a 20-year career window. Imagine you commit to investing $500 a month into a portfolio yielding 3.5% with dividend growth. Over 20 years, your direct out-of-pocket contributions equal $120,000. But thanks to asset growth and automatic dividend reinvestment through DRIP, your total portfolio value grows to approximately $295,000. At that stage, a 3.5% dividend yield pays out over $10,300 every single year in pure cash. That is over $850 every month coming in passively. You contributed $500 a month, but now the portfolio itself is generating $850 a month in cash while holding a stack of assets worth nearly $300,000. Example number 4, dividend growth versus fixed yield. This is where people often get confused. Let us compare putting $20,000 into a static account yielding a fixed 4% with no growth versus putting $20,000 into a dividend growth company that pays a starting yield of 3% but increases its dividend payout by 8% every single year. In year 1, the static yield gives you $800, while the dividend growth asset gives you $600. Static looks better at first, but by year 7, because the growing company keeps raising its payout, its annual payout catches up and hits $857. By year 15, That growing dividend pays you over $1,900 annually on your original $20,000 investment. Your yield on original cost jumped from 3% to nearly 10% because the company kept raising its cash payout year after year. Example number 5, building a financial buffer for retirement. Imagine a 40-year-old who has built up a $200,000 portfolio by saving diligently. If that entire portfolio sits in a dividend ETF yielding 4%, it produces $8,000 a year, or roughly $666 a month. If they keep that portfolio growing for 10 more years until age 50 without adding another dime out of pocket, reinvesting all dividends, the portfolio can expand to over $400,000, delivering over $16,000 a year in passive cash flow. That is over $1,300 a month of steady income waiting for them in early retirement, supplementing whatever else they save. Seeing those numbers makes it clear why people love this strategy. But dividend investing is not without traps, and plenty of beginners ruin their progress by making easily avoidable mistakes. Let us run through the most common errors and myths so you can protect your cash. Mistake number 1 is yield chasing, also known as falling into yield traps. Beginners often open up a stock screener, filter by dividend yield, and see a company offering an incredible 12% or 15% yield. They think they found a cheat code. But ask yourself this: why is the yield so high? Remember, yield is dividend divided by stock price. If a company's stock price collapses because its business is dying, the calculated yield mathematically skyrockets. A company struggling with declining revenue cannot sustain paying out massive checks for long. Eventually, executive leadership cuts or eliminates the dividend entirely. The stock price crashes further, and you lose thousands of dollars chasing a high yield. Rule of thumb: extreme yields above 8 or 9% are often red flags unless you are dealing with very specific regulated structures like real estate investment trusts. And even then, you must check financial health carefully. Mistake number 2 is ignoring total return. Dividend income is fantastic, but dividends are only one half of your total financial return. Total return equals capital appreciation. How much the share price goes up, plus dividend income. If a stock pays you a 5% dividend, but the share price drops 7% every year, you are losing money overall. You want companies or funds that provide a healthy balance of capital growth alongside growing cash payouts. Mistake number 3 is failing to understand how taxes apply to dividends. In a standard taxable brokerage account, dividends are categorized by the IRS as either qualified or non-qualified. Qualified dividends are taxed at lower long-term capital gains tax rates, which for most middle-income earners is either 0% or 15%. Non-qualified dividends, which include payouts from many REITs or short-term holdings, are taxed at your standard ordinary income tax rate, which can be significantly higher. If you want to avoid dealing with tax friction as your dividend snowball grows, holding dividend funds inside a tax-advantaged account like a Roth IRA allows your dividends to grow and be withdrawn completely tax-free in retirement. Myth number 1 is that you need a huge pile of cash to get started. Decades ago, brokers charged $25 commissions per trade and required high minimum account balances. Today, modern financial platforms allow zero commission trades and fractional shares. You can literally buy $10 worth of a high-yield or dividend growth ETF today and receive your proportional share of the next dividend payout. Myth number 2 is that dividend investing is only for older retirees. While retirees love dividends because they provide cash flow without selling off underlying shares, starting in your 20s or 30s gives you the ultimate superpower: time. Reinvesting cash payouts over 20 or 30 years creates an exponential compounding curve that is nearly impossible to match if you wait until age 55 to start. Let us clear up 3 common questions that beginners constantly ask when setting up their first dividend strategy. Question 1. Should I buy individual dividend stocks or stick to dividend ETFs? For 90% of investors, starting with a dividend ETF is the smartest move. Buying individual stocks like Apple, Coca-Cola, or ExxonMobil requires reading earnings reports, tracking balance sheets, and monitoring competitive risks. If one individual company hits an operational crisis and slashes its dividend, your portfolio takes a direct hit. A dividend ETF like the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, or the Vanguard Dividend Appreciation ETF, ticker symbol VIG, holds tens or hundreds of top-tier dividend-paying companies inside one ticker. If one single business in the index underperforms, the impact on your total income is minuscule, giving you instant diversification and broad protection. Question 2. How often do dividends actually land in my account? Most American public corporations pay dividends quarterly, which means once every 3 months, usually in March, June, September, and December. However, some investments, including certain real estate funds and specialized ETFs, pay out on a monthly schedule. If you own a portfolio of multiple quarterly paying funds with different schedules, you can easily arrange it so you get paid cash checks multiple times every single month of the year. Question 3. What happens to my dividends if the overall stock market goes into a recession? This is one of the biggest hidden strengths of high-quality dividend companies. During market downturns, stock prices swing wildly based on investor fear. But stable, essential businesses that sell goods people buy regardless of the economy, like toilet paper, toothpaste, food, and electricity, continue making profits. Historically, established dividend-growing companies known as dividend aristocrats, companies that have increased their dividend every year for at least 25 consecutive years, have maintained or even raised their cash payouts during recessions, even while their stock prices were temporarily down. That means during a downturn, your automatic reinvestment drip feature actually buys more shares at discount prices using steady cash dividends, setting you up for massive growth when the economy recovers. We have covered a lot of ground today, from the core mechanics of dividends to real-world calculations, yield traps, and tax considerations. Now, let us turn this knowledge into immediate progress. Here are 4 practical, realistic steps you can complete this week to get your dividend snowball rolling. Step 1. Open or log into your primary investment account. Decide whether you want to build your dividend stream inside a taxable brokerage account for penalty-free early access to cash or inside a tax-advantaged account like a Roth IRA for tax-free growth. Step 2. Pick your core foundational asset. If you want a simple, set-it-and-forget-it core holding, research popular dividend growth ETFs like SCHD, VG, or VYM. Look at their underlying holdings, expense ratios, historical dividend growth rates, and yields to see which matches your personal time horizon. Step 3. Turn on automatic dividend reinvestment inside your account settings. Look for the drip toggle or option in your broker interface, and make sure it is switched to automatically reinvest all dividends across your portfolio. This ensures every penny of cash you receive is put back to work instantly without hanging out as uninvested cash. Step 4. Set up an automated monthly transfer, even if it is just $25, $50, or $100. Consistency beats timing the market every single time. By setting up automatic monthly contributions alongside automatic dividend reinvestment, you create a self-sustaining financial flywheel that grows larger every single month of the year. As a quick friendly reminder, this video is for educational purposes only and is not financial advice. Building wealth takes patience, time, and consistent habits, but starting early is the greatest advantage you will ever have. Pick one small action step, execute it today, and watch your future self thank you for taking control of your financial destiny.